The number your lender approves you for is not the number you should actually spend. Hello, my name is Heath Barnes with Yield Mortgage. I've been in the mortgage business for the last 25 years. As a mortgage lender, I'm about to tell you how something most people in our industry won't speak out loud. Getting approved for the maximum amount is the fastest way for you to become house poor. So in the next 10 minutes, I'm going to show you how to find the payment that fits your real life scenario and not the one that traps you, so that you can shop with total confidence instead of fear. There's a huge difference between the house you can get and the house you can live with. Buy at your max, and every little surprise like a car repair, a medical bill, or even a slow month will feel like a crisis. Buy at your comfort number, and you actually get to enjoy the home. By the end of this video, you'll be able to calculate your real comfortable price range yourself and walk into your next pre-approval meeting ready, knowing your number instead of letting someone else handle it for you. So let's start with how lenders actually decide on your price point. Everything comes down to one thing, and that's, well, the one thing that most lenders obsess over. It's your debt to income ratio. It's a percentage of your total income that goes into your debts. There are two numbers inside of it. The first is your housing payment compared to your income. The second is all of your debts, your housing, your car, your student loans, or even your credit cards compared to your income. As a general guide, a lot of loan programs like to see your total debt land around 43%, but it can go up to 50% of your total gross income. Or under some programs, they'll even allow you to go a little higher. Here's the trap. A lender might approve you right up to your ceiling, but the ceiling assumes nothing in your life ever goes wrong. Filling your budget to the absolute top is like filling a glass of water to the brim and then trying to carry it across the room. One bump and there's a spill. So let's talk about a smarter number for you. Here's the rule that I actually like to use. I aim to keep your housing payment around 28 to 30% of your gross monthly income. Pull it lower if you've got goals like travel, kids, or some aggressive saving plans. But for the most part, 28% is a really good number. Let's make this real. So let's say your household brings in $6,000 a month before taxes. The max a lender might allow you to push for is up to $2,000 a month. But a comfortable number on this price point might be $1,600 to $1,700. The gap, about $300 to $400 a month, is the difference between feeling squeezed and feeling free. It's your buffer for life. And honestly, your future self will thank your present self for leaving you a little bit of room. Now, the biggest mistake most first-time homebuyers make is they look at the price of the home, they plug it into a calculator, and they think the number that's in the payment is their payment. It's not. Your real payment has four parts. Number one, it's your principal, the chunk that actually you pay down when you borrow. Number two is the interest, what a lender charges you to borrow the money. This moves with the interest rate, which is why your payment can swing even on the same price home. Taxes, property taxes, they're typically baked into the monthly payment if they're held in escrow. What an escrow account is an account that actually holds your property taxes and your insurance so that you have the money built into the payment. So these can vary wildly depending on the area that you're looking at for homes. Even if the home is the same price, if it's in a different area, it could have a higher tax rate. And then the last is your insurance. There's homeowners insurance, which is escrowed, but if you put more than 20% down, you don't have to escrow it. So typically your payment includes principal, interest, taxes, and insurance. That's homeowners insurance. If you don't put 20% down, you're also going to have maybe 20 to 30, even up to $100 a month in what we call mortgage insurance. So when you shop, you're not shopping for a price, you're shopping for principal, interest, taxes, and insurance payment. Two homes at the same sticker price can have a vastly different monthly cost when you calculate taxes and insurance. That's the number that they fit into your 28% debt to income ratio. And even principal and interest taxes and insurance isn't the whole story when owning a home. When you rent, the landlord eats the surprises. When you own, you're the landlord, so you have to budget for these. These items are like maintenance. A good rule of thumb to set aside is at least 1% of the home value a year for upkeep. On a $350,000 home, that's about $3,500 a month that you'll need to put aside for a future water heater, a roof, your HVAC system, and many other things. Also, your utilities. Your first home is often bigger than your apartment. Heating and cooling has more square footage, so the cost is going to be more. You need to plan on that. And not even to mention, like whether or not the house is properly insulated. So you could have utilities that range widely in comparison. A good rule of thumb is to ask the previous homeowners if they can provide you a utility bill so that you can get an idea of what your future utilities might be. And then the third is homeowners association dues. Some neighborhoods and condos charge a monthly fee. It can be small or it can rival a car payment. It's always to ask up front before you fall in love. What is the HOA that I need to pay either monthly or yearly? Now, this is why I tell people leave a buffer. The comfortable number isn't me being cautious for no reason. It's me protecting your weekends, your sleep, and even your savings account. It's me protecting you against your future self. Let's run some numbers real quick right now. 3 quick steps. Number 1, take your gross monthly income, everything you make before you take out taxes, and use $6,000. Step 2, multiply that 6,000 by 0.28%. And that'll give you $1,680. That's your target payment. Step 3, remember that the $1,680 has to cover your principal, interest, taxes, and insurance, not just your loan. So the actual home price you can comfortably target will be lower than a basic mortgage only calculator tells you. Plug your own income into that, and you've got a starting target within 30 seconds. That's your shopping number. Anything a lender approves you for above that is optional and usually a trap. Here's the shift I want to leave you with. Don't ask, what's the most I can get approved for? Ask, what payment lets me still live my life? The buyers who stay happy in their homes for years aren't the ones who are scratching the ceiling. They're the ones who left themselves room to breathe. So tell me in the comments, what's your 28% number? Just the results. I'd love to see how many of you are closer than you thought. And if you want help finding the exact comfortable payment for your income and goals, not just your maximum approval, the link has a no pressure conversation in the description. Don't buy the most, buy what fits. I'll see you on the next video.